Are there any companies that you just wish you could invest in, but they don't trade publicly on the stock exchange? Well, that could all change if that company decides to hold an IPO. This will give you a chance to be amongst the first people in the world to publicly purchase the stock. In this video, we're going to explain exactly how IPOs work and what you need to know. Make sure to stick around to the end of the video where we discuss whether investing in IPOs is actually worth it. An initial public offering, or an IPO, refers to the process of offering shares of a private corporation to the public in a new stock issuance. Basically, this is when a privately owned company goes public to try and raise money through the primary market. To hold an IPO, companies must meet certain requirements that are set by the stock exchanges that they are trying to enter. Companies hire investment banks to market, gauge demand, and set the price and date of the IPOs. This leads to a lot of excitement as a lot of prospective investors want to be the first people to get their hands on the new stock. Some companies that held an IPO in 2020 include the Chinese EV company XPeng, the big data company Palantir, and the travel and hospitality giants Airbnb. There are multiple reasons why companies like this choose to hold an IPO. These companies have the chance to raise capital from the entire public that invest on the stock market. Also, it increases the company's profits, image and prestige, which can improve their sales and reputation. These companies have to report their earnings quarterly, which makes them more transparent, which improves their credit borrowing terms. However, there are some disadvantages that are associated with holding an IPO. IPOs are expensive, and the cost of maintaining a public company are ongoing. There is a risk that funding will not be raised if the market does not accept the IPO price. There is some loss of control, as shareholders obtain voting rights that can control key company decisions. So, let's say you hear about a company that is going to hold an IPO. Should you get involved? To determine this, let's have a look at how investing in IPOs usually goes. First of all, getting your hands on an IPO early is going to be difficult. Big institutions with large sums of capital and a lot of reputation are most likely to get distributed the stock first. To be in with the chance of getting your hands on a new hot IPO stock, you will need to register your interest in advance. Even then, you will still likely be late to the party, as a hot IPO will have already rocketed in price before it is available to retail investors. Another consideration is how long you intend on holding the stock for. If you are wanting to hold the stock for less than a year, hoping to ride the hype wave of when the IPO first launches, then you will be paying more tax when you sell the stock. Holding any stock that you have held for less than a year will fall under short-term capital gains tax, which is higher than long-term capital gains tax. But let's say you do get your hands on the stock early, and you intend on holding the stock for a long time. What will the performance be like? This was covered by J. Ritter in 1991 in his paper, The Long-Term Performance of Initial Public Offerings. He studied 1,526 IPOs from 1975 to 1984. He showed that the average returns of these companies 3 years from the IPO launch date was 34.47%. However, this was compared to 1,526 companies which were in a similar industry and had a similar market value. These stocks had an average return of 61.86% over the 3-year period. So this research is suggesting that IPOs aren't all that they're often made out to be. But what are the causes of this? Ritter claims that the main source of this underperformance is the over-optimism that surrounds IPOs. As everybody is excited to invest in the new prospect, new investors tend to overvalue that company. People therefore pay higher for the IPO as they are expecting the IPO stock to perform positively. This will cause the value of the IPO stock to rise, which actually reduces the expected returns of a stock. Finally, when the hype of a stock dies down and the true performance of a company is reflected in their earnings, the stock starts to drop in value. In his research, Ritter quotes the work of Stoll and Curley in 1970, which says, "In the short run, IPO stocks can show remarkable price appreciation. In the long run, investors in these small firms did not fare so well." So, what does all of this mean for IPO investors? IPOs are typically smaller companies that apply to raise funds from public investors through the stock market. Depending on the hype around the company and the investing opportunity, the demand for these stocks can be extremely high upon release. However, if you're an average retail investor, then you will be at the bottom of the list when it comes to getting hold of these shares. If the IPO launch is successful, then you will have to pay a high price for these shares, as the stock price will have already rocketed. If the IPO price is unsuccessful, then you may get the shares for the price you wanted, but this might not be a good sign for the company. After missing out on the large initial growth that some IPOs can experience, you will obtain results that will likely underperform the market. As with any stock, you could strike it lucky and pick a winner. but the research shows that this is a statistically unlikely event. And with that, make sure to subscribe to the channel and follow us on Instagram at iQinvesting UK for more investing content every week. If you enjoyed the video, please smash the like button and share it with a friend so that they can learn about IPOs too. Do you prefer to invest in IPO stocks or do you avoid them? Let me know in the comments below. As always, thanks for watching.